We collapsed through 140 this morning, which has been the long-term historical floor since the mid-80s for the pound against the dollar. We dropped down to 133. We've now come back to just test 140. So what we're seeing here are traders ascertaining whether what used to be the floor for the currency is now the ceiling. A lot of people are saying and have predicted that if we did see a Brexit, we're going to get to 120 and potentially lower on sterling. That's still in play. Equities sold off hard early this morning when the FTSE opened. We've come back a little bit, but we're still down roughly 5%. The big question now is, does a Brexit affect the economy? Does activity slow down? And does that mean home builders, retailers and banks get hit? So those are the three key sectors for the FTSE. Now, there is a silver lining here. The FTSE 100, for example, relies on a lot of foreign-based earnings. As the pound sterling weakens, their foreign-based revenues will increase. What you could potentially see in the next couple of months is an M&A bonanza, where foreign-based companies look at UK multinationals and say, I can buy that company a lot cheaper now because it's priced in sterling terms, but their revenues are actually going up because sterling's weakening against the dollar. The FTSE 250, which is the domestic barometer, however, things look pretty grim if indeed you do see a much slower, potentially a recessionary Britain. So that's why the FTSE 250 dropped as much as 12% earlier today. 10-year gilt dropped down towards 1%, new record low. The expectation here is that the Bank of England will at some point ease policy, maybe do more QE, in conjunction perhaps with more easing from the ECB and other central banks. Therefore, just buy bonds and hold those yields. 5 days ago, risk appetite began to increase because a lot of people in the markets believed Britain was going to vote to stay. And you saw people jumping into bank stocks, not just here in the UK, but in the US, even in Japan, across the world. And there was a big risk-on rally. And that effectively sort of reflects the fact that next Thursday's end of the second quarter, not a lot of investors had a good Q2. So the idea here was jump on this bandwagon, surf the momentum of the UK voting to stay, and you're going to look very, very good. That has completely blown up in the face of a lot of macro funds, macro hedge funds, big traders. So what we could potentially be seeing in the coming weeks and months are a number of the bodies coming to the surface, funds that have blown up. And that's going to actually spill over into the global markets. And we are seeing that. We're seeing the yen get dramatically stronger as a byproduct of the sterling's weakness. We're seeing the dollar strengthen against emerging markets. So cast your mind back to what we saw back in February this year. We could potentially be seeing another replay of that scenario, which means investors are going to continue to buy top-tier bonds such as US Treasuries and gilts and the German Bund, which today fell to a record low of negative 18 basis points. They're going to shun commodities like oil and copper, but buy gold, and gold indeed has broken out to a 2-year high this morning, above $1,300 an ounce, and they're going to steer clear of equities.